Armin, Kakas, one of the partners at Revology. Good to have you all. We typically do these webinars once a month, mostly educational in nature, and typically these are based on real case studies that we've done with various industries and different companies. And we try to do a good blend of pricing, revenue management, data science, maybe some AI. But yeah, they've been very popular, so thank you for those that are attending. And obviously, Enrico is going to talk more about today's session, but we're exclusively focusing on pharma pricing analytics, right? Borrowing sort of a lot of concepts that we've done from CPG and mired in some actual case studies that we've done. So great to have everyone, and turn it over to Enrico.
Yeah, thanks. And on that note, as Armin mentioned, if you have ideas or topics that you're very passionate about or you're curious about and are very, let's say, applicable to today's pricing environment, drop us a note. We're always building out a pipeline of future monthly webinars, so we'll be happy to incorporate your input as well and hopefully tackle it as soon as possible in a progression. My name is Enrico Sieni. For those who haven't met me yet, I'm originally Italian, hence the accent. And I've been practicing pricing for the last 2 decades, working alongside primarily B2 type of companies. And I've created and led pricing teams from scratch. And now together with Armin and our sister company Revify, we're helping organizations of different sizes and across different industries on improving their own pricing processes. The plan for today is to cover the next 50 minutes or so with content that we've prepared and give you some real life examples of work that we did with pharma customers. And we are open to live Q&A. So you'll see a Q&A button at the end of bottom of your screen. Feel free to put in a question anytime there, and we'll be able to, or we'll try to answer those as timely as possible during the session. And then if anything else is still pending, we'll incorporate that in the feedback as we send out the material. We'll cover some of these slides fairly quickly, so don't feel like you're losing that train of thought. You're going to have it all in your inbox, so you'll be able to refer to it later on. But before we spend more time on this, I'll pass it on to Armin and let's get going.
Yeah, great. Yeah, thank you. I'll try to be quick. So a blanket statement, we've seen this across some of the pricing analyses in pharma, right? We do some kind of basic comparison of our prices versus relevant competitors, right? And we find out that we're cheaper. And of course, the proper way to do that is to equivalize things on a defined daily dose, right? And so a lot of the times we see that there are in fact big differences, right, between sort of normal pack-based price points versus price points that are actually based on the proper therapeutic DDD values, right? And so it's one example, right? The other piece that we've seen quite often, and we'll talk about it more, is not just this disconnect between doing proper product equivalence and a proper equivalized price point comparisons, right? But a lot of times companies anchor to just catching up with inflation, right? Or catching up with consumer price inflation and not understanding elasticities, et cetera, et cetera. And so the cumulative effect of all these capabilities that either don't exist for pharma companies, or if they do exist, they're very manual, lots of data stitching, et cetera, et cetera. Just by having these capabilities, you can immediately drive double-digit price realization for your company, right? And that's actually like a fairly trivial thing to do when you have portfolios, especially in emerging markets where you may not have had the level of sophistication or where data is incredibly disconnected. If you can move to the next slide. Yeah, so we'll cover obviously where some of the price leakages occur in pharma. We'll talk about the 4 capabilities, and I just want to reemphasize what those are, right? It's basically this whole
notion.
You're
going to spoil it, Armin.
What's that?
You're going to give a spoiler alert.
Oh, sure. I'll
go for it.
I'll go in sequence, right? So we'll talk about the 4 main capabilities, and maybe I won't spoil it. Stay on. But we'll talk about what actually makes this reproducible, right? So I'm a big fan of reproducibility. I see this all the time. And of course, most of our clients are at the upper end of mid-market, so up to maybe $2 billion. This includes kind of business units within global companies. But still, like even in the age of AI, where people have used the term, we still see just a lot of manual work around data integration and pricing analytics and validation. And so reproducibility, in my mind, is a big thing, right? And we'll talk about the engine. What do we mean by the engine? We mean this set of modules that we put together that we can enable for companies, or you can enable in your own companies. And we'll talk about what that is and how you actually build that. And we'll talk about how do you drive adoption. If you go to the next one. Yeah, so probably the biggest issues that we see, right? So we talked about the data fragmentation. And by the way, this is not unique to pharma. We see this in every company. CPG is also dealing with the same thing, but you have your ex manufacturer prices and or one system promotions and rebates on your net price and maybe another system for some companies. And then you have syndicated data. And typically you have two versions, right? You have local IQVIA data for whatever country affiliate that you're dealing with, and you have more standardized data, but sometimes you don't have the standardized MIDAS data for some countries, right? And so it requires some data stitching and some normalization, right? And you may have Navlin, which tends to be like a very janky syndicated data set, but also needs quite a bit of cleanup. And so one of the challenges is the ability to stitch all this data together. Like, how do you do that? The second piece is we've seen a lot of kind of approximate price analytics. When we try to do competitive price index analyses, how's my SKU versus the relevant competitor basket, and what is the methodology through which we evaluate price gaps? That's not always standard in companies. And if you ask 2, 3 different people in the organization, you're going to get two to three different answers, right? And so approximation is one issue. Generalization is another issue, right? For many companies, the product managers or brand managers, they have a pretty good idea of what the competitive set is, but a lot of it is manual work, right? And it's heuristics, experience-based. Yeah. No one individual can keep track of all the innovation that's happening, particularly around generics and so forth. And so this whole idea of matching up SKUs based on the right set of therapeutic areas and the strength and form and route of administration and pack sizes and et cetera, and knowing what the proper defined daily dose is for that particular treatment, right? Because you can have the same molecule and the same drug, but it may have 2, 3 different kind of treatment areas. And your company may be focusing on one, and the competitor may be focusing on another one. And guess what? Then itself produces different defined daily doses and therefore different pricing profiles. That's an incredibly manual effort for a lot of pharma companies. And there's a way to build this systematically where it's all automated. And then the last piece is just stagnation, right? Because this takes such a long time, even getting proper, I would say, price optimization insights for one brand could take a couple of months of somebody's time, right? And now imagine extrapolating that across multiple entities or affiliates and multiple brands. And now you're talking about an effort that many organizations are not able to undertake just because of how things exist today, right? And so that's why reproducibility is so important, right? I would say maybe largely kind of it's re-emphasizing the points that I've made before, which is one, the markets are heterogeneous, right? So you do have different channels within the same countries and different channels operate differently. So your retail or pharmacy channel is certainly going to be very different than like a hospital or like a government tender channel, right? Some countries may have reference pricing bands that they use. Some countries may certainly have rules around how much your price increase can be that may be indexed to some consumer price inflation number or some other kind of pharma market basket or competitive market basket. But you have to know and you have to encode all these different rules in your data, and it has to be centrally available versus it just resides in some country affiliates, spreadsheets or random documents, right? If we move to the next one, this is probably the biggest leakage areas, right? So again, we talked about the lack of competitive clarity, and a lot of the times we also often miss competitors that may be in the data set because we haven't done the systematic, reproducible way of creating these product equivalence matrices, right? Number two, what we often see is the way we define pricing opportunities and what the right pricing actions should be, they're not consistent in the organization. And you may have one market in Latin America that thinks about it very differently than a market in Asia versus a more established market, let's say in Western Europe. And so your organization needs to have very consistent, standardized ways of understanding and evaluating pricing opportunities and a very standard way of mapping out all of your data assets that will help you do those things, right? The third one is I'm going to talk specifically about this idea of understanding price sensitivities, which is really tricky in pharma traditionally. And it's been a lot more, certainly heavily used in consumer products, but it's still very nascent in pharma. just at least based on our experience. So we'll talk about how we do that properly. And then, of course, the last piece is just the ad hoc analytics. So a lot of this analysis around what is our right to price versus competition? What should be our right price back curve for our brand? Are we leaving money on the table because we're not pricing a drug with 2 to 3x the strength index versus another drug properly? This is a very painstakingly manual analysis that needs to be, again, systematized. And all these things on a cumulative basis leak quite a bit of margin for companies that, depending on your scale, can add a tremendous amount of value. If we go to the next one, so just a quick informal poll, if you will, very optional. Just maybe comment in the chat, what's been your experience? What do you think is the biggest driver of performance erosion? It could be, we put volume, but it could also be just the revenues or profit. Is it pricing? Is it competitive pricing actions? Is it just crazy amounts of innovation that's crowding your market? Or is it your ability to spend more or less on advertising and promotions and call detailing or sales force activity or distribution? So feel free to comment. Just think about it as we talk through the rest of the presentation, and drop it in the chat and we can discuss. So.
Yeah. In the majority of cases, we price, right? That's the first one everyone talks about. But what is interesting in pharma is that you do have some of these other factors coming into play, which is nice to see for once, right? Because price is not always the culprit for everything. So it's interesting. Yeah, someone mentioned competitive innovation. That's a great one, right? Other products coming in.
Yeah. Okay, so let's move on to the next one. So here's largely what we're going to talk about in this presentation, right? So we've worked with some amazing individuals in pharma. And in fact, my personal experience has been, I think pharma largely has some incredibly qualified, smart folks, especially like when we look at kind of the headquarters environments. What we tend to see is just the lack of capacity, right? As I think about pricing and revenue management teams, the staffing method that I tend to see in pharma is certainly lagging behind what I tend to see in like CPG, right? And forget about the travel and hospitality industry, like they have armies of kind of pricing folks. But for the most part, pharma is still heavily understaffed when it comes to a central COE type pricing and revenue management capability. And so what we've done for other pharma clients is build this kind of integrated, automated or semi-automated capability that addresses 4 modules or 4 capabilities, right? One is competitive pricing analytics that is based on this concept of a product equivalence matrix that is also automated, and this idea of having a defined daily dose equivalized prices. So we have an apples to apples comparison of our price position versus the competition. The second piece is, which is really borrowed from CPG. And there's a few kind of more sophisticated pharma companies already doing this notion of right to price, or sort of what is your price relative to your perceived value? And we'll talk about how you measure right to price. And some of it is subjective, some of it is quite empirical, but we'll talk about that. And the third piece is the price pack architecture, right? So again, not just what is it price per pack if we look at, let's say, tablets across multiple accounts, but also do we have the right architecture when it comes to different strengths, right? Do we have the right architecture when it comes to branded versus generics, right? The fourth one, which is underpinning all this, is having a strong understanding of causal elasticity, which enables us to not just segment products into similar groups, but more importantly, helps us with pricing simulations, right? What happens if we increase prices up or down relative to the competition? What happens if we give more or less promotional funding? What happens if we cut the budget for AMP? What is the impact on our demand and our profit and our revenues, right? So we'll talk about each of these steps, and we'll start with equivalence. I'll turn it over to Enrico.
All right. Thank you, Armin. So equivalence is the building block, right? The good news is that all these companies have a lot of data. The bad news is that it's not always organized in a way that can actually be leveraged from the get-go. And so what is the reporting feeds that you have are never been built to be a comparison set out of the box. They tell you what you sold, but they don't tell you what you should be measured against. And so, as Armin mentioned before, teams do it by hand. Someone sits down and matches your SKU to a competitor SKU, and that works until the next data refresh when it all breaks and someone has to do it all over again. And sometimes it's not even the same person. So you can imagine how much you can compare between those two different data sets. And the quite danger of this exercise is just 1 week match a product that is not really comparable, all of a sudden discredits all the quality work that people have been doing behind the scenes. And so once you start seeing a number that is a bit off, nobody is able to understand or explain why, and the whole credibility of the pricing exercise goes away. So the fix is to stop matching by hand and actually creating a set of rules that are encoded. And that way you can actually score every candidate pair that you come across. And you start creating gates so that then the human review doesn't have to go through one by one, but it can actually help set the right parameters so that you can determine what the matches should really mean, right? How accurate are the matches? And what at the bottom of the screen are 9 attributes that we've used. So it gets very complex, right? You start looking at each of these individual areas. The DDD, for people who may not be as close to the pharma, is the daily drug dosage. And that's one of the key metrics that you can use to start equivalizing data between different vendors. But what we've seen from pharma is that even this list of 9 is not fully comprehensive, right? In some cases, you also have the the therapeutic area, right? And so one drug could be applicable to multiple therapeutic areas. So this list may be even longer, which means again that you cannot do it manually. It's just impossible. So how does this work? So the idea is on the left-hand side, you have all these feeds. Armin mentioned IQVIA, which is one of the largest vendors of market pharma data in the world. And it both comes in flavor of local data and Midas, which is their attempt of creating a global database. But there is at least 6 to 9 different feeds that pharma companies have access to. And again, all of that needs to come in together in one engine. The special thing that we created with what we call the PEM, so the product equivalence matrix, is an engine that incorporates the rule-based logic. So the data, how do we actually determine if it's a match or not, together with advanced analytics. And in a case was machine learning around fuzzy matching on names. And you can imagine that as you start pulling together global data, you also have differences just by language, right? So a Spanish country could refer to a gota, and in the global database is a drop. It's the same word, right? It's just different language. And so that's closer to a match. So all of these need to come together. You cannot do it by hand. So machine learning and automation helps tremendously in that regard. And then the output is an equivalence score, which is what on the right-hand side. And so you could say at a glance, hey, we found a top match. We have a score of 98. That's close to nearly perfect. But the idea is that every strategic decision hangs after the scoring so that you know that you're comparing apples to apples at the SKU level automatically. Once you start seeing that scoring start dropping off, that's when you start having the interesting conversation to say, okay, is this a similar product? And if so, in what sense? Could this be an expansion area? Competitors have a product in this area, we do not. Should we be launching this? Is it white space? So it starts encouraging a richer conversation beyond pricing, but you need to be able to create these segments. So once you have a complete data set and now you have trust around apples to apples, then you start fixing that core issue that Armin was mentioning about. And now you can start actually comparing pricing and making clean decisions around pricing. So you now know what the standard price is, you know how the DDD, right, the daily dose for the drug that you have from external references or internal experts in the company. And now you can start computing price per DDD, which is the ultimate equalizer to be able to compare price apples to apples compared to your competition. And then the last step, once you've done that, you can now create CPI bands, right? So the actual competitive price bands across the different products. And this is really where it gets actionable. So under 90, for example, it means that you're below market, and that could be a price increase candidate, right? You're leaving money on the table. If you are 98 to 102, you could say, hey, I'm at parity. And again, with the client, we can set those thresholds to what they prefer to do. If it's a very rare and very surgical price, you may have very narrow bands, but if it's something which is more of a commodity, those bands may be allowed to go wider. And then you have the ultimate spectrum, which is in this case 110 and above, and that's where you know that you're significantly priced above market, and so you may be losing some volume, which could be generating extra margin if you're willing to do some experiments on price, which Armin will talk about in terms of the elasticity. So again, none of this can happen if the underlying match is weak. And so you need to come to a place where you have all this data lined up, high level of confidence, and a way of being able to explain why you think this pair is a genuine match that you can take action on. Let me pass it back to Armin.
Perfect. Yeah, we can maybe go to the next slide. So again, right to price, very similar concept as what we've seen in kind of consumer products, where we look at perceived value versus relative price, and we make pricing decisions based on that. But for the most part, what we mean by that in pharma is, what is your perceived brand value relative to other brands that are your direct competitors, right? And you can do it several different ways. This is just an example of how you can do it in your particular companies, right? You can have 6 or 7 different categories around brand equity, value differentiation, quality worth, market stability, supply reliability, access and channel, and then competitor alternatives, right? For each of these categories, some of these will be quite empirical. For example, things like market stability, supply reliability, if you have strong kind of internal inventory and supply data, right? The same thing with access and channel and the competitive alternatives, or maybe you can also measure, let's say, market concentration, right? These are mostly empirical. Things like brand equity, things like maybe differentiation, but certainly quality. Maybe you can also add things like kind of other value-added activities that your sales force provides relative to some other brand, right? But the point is, you need to come up with some set of categories where you can weight each of those categories and score your brands and those of the competition. Now, ideally, again, some of these categories will come from actual surveys directly from your customers, right? Not the actual end consumer or the patient, but the actual customers like physicians, right? Because you want that to be an independent measure of how they think of your quality versus your competition. But what you end up with is you end up with a weighted score, right? And what that weighted score allows you to do, if you can go to the next slide, again, this allows you to come up with this right to price or this perceived value score between 1 to 10 or between 0 to 10, right? Either interval is fine. And typically what ends up happening, and we do this a lot and again in CPG, is depending on what your score is, you would have some research-backed price indices where you should be positioned relative to the competition. So for example, a score of between 1 to 3 means this, and your ideal price index should be between 60 and 70 relative to the competition, meaning between 30 to 40% cheaper, right? And again, on a price per DDD basis, right? If your brand value or perceived brand value is really high, it's an 8 or a 9 or a 10, guess what? Your ability to price relative to your competition is now going to be higher. And I think, again, this is one step that I think many companies, especially more mid-market type pharma companies, miss, right? Because we're typically just looking at price indices and we may look at price per DDD, but we actually miss this point of understanding what is our market share and what has been the momentum relative to other brands, right? And how has the demand stability been? And what is the life cycle of this particular brand or drug that we're looking at, right? And based on these components, you can arrive at a fairly surgical score that now allows you to have a much better sense for what your pricing should be relative to competition versus just arbitrarily saying, oh, we need to be at parity or we need to be at 10% more, right? And so again, illustrative example, but depending on what your score is, you may come up with these different archetypes, right? Like high equity franchise player or a mid-tier brand, or it's a niche specialty drug, or it's a new innovation, right? And notice the price index band or the right to price band is going to be higher for a high equity franchise, well-established brand versus, or it's going to be, sorry, higher versus a niche specialty where the band may be compressed. But these things will allow you to basically determine how should you be priced relative to your competition, right? So if you're priced above the peers and demand is incredibly price sensitive and your volume has been decreasing and it's a really crowded competitive set, guess what? You may need to decrease and you need to invest in price versus if you're priced below the peers, but your demand has been very steady, strong market share, strong momentum, brand has actually been growing despite the fact that you occupy a leadership position, you need to increase the price, right? And so again, this right to price concept or this perceived brand value concept coupled with your price elasticity and coupled with your current price position is a really strong formula for you to be able to figure out what should be my optimal price and how I should be adjusting prices.
Perfect. And then the next one is capability free, which is a price pack architecture, right? So this is the package sizes of the drug that you provide. And this is another area, as Armin was mentioning before, you do the external point of view of how you're perceived in the marketplace, but then this is now looking inwardly to determine how do you set your own prices. And typically, you would expect that a price pack architecture follows a logical ladder, right? So the bigger pack should have a lower price per unit. And so you're creating an incentive for a consumer or your customer to buy a bigger pack because it makes sense, right? There's a logical step there. And it should be a smooth curve, typically. But the reality is then reality kicks in, and over time, those ladders tend to decay, right? And so it's not broken on purpose, but it's years of staggered inflation moves or one-off discounts here, a price cap there, a launch price that never quite fit, competitor price moves and so on that people react to. And so as you can see in the chart, the green line is the architecture that you'd expect, and the dark line is an example of what we found at the client. So they've come apart. And they say the green line is how we always price it, right? That's our thinking of how our consumers will reward us and buy larger pack sizes. But then when you plot the actual data, you start seeing that's not always the case. And so when you look at this, you look at it at a pack index, so your packaging size. You look at it as a strength index. So as Armin was mentioning before, you will look at to determine what is the natural increases in strength. So you may have a 1.5 milligram dosage, a 3 milligram dosage, 4.5, and so on. So replace the bottom axis with strength to plot the same way. And then an equivalent price index. And so that way you're comparing apples to apples over time. And what is that? More details in the white paper. That's really start exposing key areas that where things fall apart. And this was one example that we plotted out from a customer. On the left-hand side, the pack multiple sizes, you see the per unit index that you would expect, so the drop in discounts, and then the implied discount that we calculated from the actual data. And you will see that at a pack 5 times higher than the base pack size, you start seeing that the math doesn't quite work anymore, right? The actual data was suggesting that as you increase the pack size by 5 times, you end up with the same price per unit as the 6 times pack size. And of course, that's an opportunity to start redefining those price points, and there's money there, of course. Back to you, Armin.
Perfect. Okay, so let's talk about elasticities. Maybe move on to the next one. One of my favorite topics. So we've actually seen this not just in pharma. We've seen this in other industries where I think teams have the best intention and they try to estimate price sensitivity by looking at year-over-year price changes versus year-over-year changes in demand, right? Because you're very kind of classical economic definition of what price elasticity is, right? That's kind of like your basic math version. And often what we end up with is we end up with not only positive coefficients, but sometimes double-digit positive coefficients, which we know is not true, or it cannot be true, right? I suppose unless you're selling a Louis Vuitton bag or some kind of other luxury product, right? And so this is actually a real case where we've seen companies do these calculations. And of course, the reality of doing price elasticity using proper modeling is very different. We use, if you can go to the next slide, we've started using probably over the last, I would say, a year and a half. We migrated certainly away from traditional regression models. We haven't used those since we started Revology, but we also migrated away from other machine learning models like random forest and whatnot that companies tend to use. And we employ something called the double machine learning, which underneath the hood, it does use some kind of tree-based ensemble models, but it really consists of two parts. For pharma specifically, we first want to model volume or demand, and you can use IQVIA data for this, off of things like price, off of things like promotions that you give and advertising spend. And I'll talk about advertising spend a little bit separately, seasonality, distribution, call detailing, right? Extracts from your CRM to figure out by brand or by product what has been your activity in a given month, right? But we try to build a two-step model. One model predicts the volume. The second model predicts the price, right? And why is that? Sometimes price will vary, or could vary. Your net price could vary by season, right? Or it could vary because there's a new competitive entrant, right? It could vary year over year because there's inflation, but forgot to add inflation as one of the variables, right? But the point is you build this two-step model where you predict volume separately, you predict price separately, and you run a final model based on the residuals, which is going to be the difference between the actual volume and the actual price and their predicted values. By definition, when you run a third model that models these things off of the residual, you end up with the unexplained, has the unexplained parts, which is to say that it truly ends up with a model that tries to get as close to possible to the true impact of price, right? Again, because things are influencing demand other than price. Maybe we can skip to the next one, Enrico. We can show the slide 26 just to illustrate, right? So again, some of the metrics, let's go to the next one. Some of the metrics that we would use that I talked about, seasonality, some various market factors, right? It could be growth, it could be competitive concentration, marketing spends, channel mix, CPI, which is consumer price index, not competitive price index, exchange rates, etc. But we build a two-step model. And what we tend to see is if you just do traditional regression where you don't include all these variables, or if you use models that don't account for the fact that some of these variables are going to be actually correlated with each other, like distribution and AMP spend, for example, you're going to end up with the chart on the left side where all of a sudden it's going to imply that as you increase price, volume is going to change, right? After you do this two-step or two-part modeling, where you remove the effect of these kind of other variables that are correlated with both demand and price, again, you're going to end up, for the most part, with the true causal impact of price. And for pharma, what we tend to see is for let's say, OTC type products, coefficients for price elasticity, they're not as high as like CPG or food and beverage, but they tend to be in that kind of negative 0.8 to maybe negative 1.1 range, right? Which is small elasticity, right? When you get into the lower than negative 1 range, that's when price increases will impact your revenue downward, right? So you have to be careful with that. But for the most part, they're still maybe hovering around that negative 1 or a little bit lower. For actual RX products, especially like more niche products, it ranges anywhere from negative 0.2 to negative 0.6 or 7 on the high end. But for the most part, they're like in the negative 0.4, negative 0.5 range, which is, again, very typical for needs-based products. And again, that's after you account for the impact of competitor price moves, et cetera, et cetera. And so what do elasticities enable you to do? It enables you to run some much better scenario analysis for your business. And the next slide illustrates that on a very simple level, right? You can estimate the impact of price changes on your volume, on your revenue, on your margin, and you can have like high-low estimates, right? And how are these high-low estimates? How do we actually define these? These are basically the statistical bounds of our models, right? The low would be like the let's say the fifth or the 10th percentile versus the 90th percentile in our model outputs, but it gives us a range, right? So when we plan for price moves, be it competitive price indexing or be it due to this perceived value or perceived brand element, we'll at least have a good idea directionally of what our pricing actions would yield. Now, one last thing that I'll comment before I continue is advertising spend. One of the things that you need to do as you model is use this concept of ad stock, right? Which simply states that money that you spend on advertising will have a cumulative effect, right? Just because you spend something in 1 month, the effect of that advertising spend doesn't just simply go away. Same concept, by the way, for detailing activities or detailing calls, right? They will have a cumulative, longer running impact. And so you need to have this ad stock component that basically has some kind of a downward exponential curve where we continue to diminish the impacts over time, right? But just a call out. So how does this all work in practice? If you can maybe go to slide 29, a couple of things. One, when we think of pricing analytics and optimization capabilities that we built for companies, we think of systems and data engineering and machine learning modeling, and we think of it in a reproducible manner. That's number one. But we also think of it in terms of kind of data quality, standardization, data contracts, et cetera, et cetera. And that's especially important for pharma, especially when you deal with 20, 30 different countries and affiliates, where you want to build these capabilities and you want to build it in a synthesized format that not only helps the countries and their leadership, but also helps your corporate team understand the opportunities. Because ideally, you want to challenge these affiliates, right? You don't want to just take whatever the insights are at face value. You want to be able to run your own analysis of XYZ country for XYZ brand and be able to uncover, this is interesting. We may have this opportunity to move price here because of these trends that we're seeing from our pricing analytics module. And so you want to be able to have that conversation, go back to their countries and challenge them, right? And I think that's where impact happens in companies, where you have a corporate team that does have access to all these insights and predictive analytics capabilities and this integrated data, where you can have these very insights and reality-based conversations with your affiliate partners, right? And so you don't need to answer now, but just think about your company, think about your kind of global environment. If you're with a global company, like where are you in terms of your pricing analytics and optimization journey, right? Are you level one where we do price analytics, but it's in a bunch of random workbooks and we kind of recreate things over and over? Or level two, we have some standardized Excel templates, right? Or three, where some of this stuff is actually in Tableau or Power BI or some other BI tool that we use in our stack, but we have some nice descriptive analytics and we can filter by time frame and brand and competitor, et cetera, et cetera. Or do we actually have an integrated predictive and somewhat prescriptive analytics capability for our price optimization? And it's also reproducible, right? And it's automated or semi-automated, where it goes through a review cycle before we approve things. Or are we at level 5, which is we not only have the tools, the reproducibility, the consistent data integration, but it's now part of an actual operating system where every month when we go into commercial reviews, we review the outputs of the actual modules and the actual dashboards. Okay. So maybe what I'll do, Enrico, is just in the interest of time, let's maybe move to slide 32 if you can, and then we'll get into some examples of the modules. So not this one, but the next one. So again, when we talk about reproducibility, what does that mean? It means that we have a automated or semi-automated data pipeline that integrates all these data elements that are initially talked about, right? Number one. Number two, we have number 2 and 3, I would say, right? We have an automated pipeline for things like normalization, deduplication, standardization of, again, what Enrico talked about in the product equivalence matrix, standardization around molecule names and therapeutic areas, et cetera, et cetera. Midas does a great job of standardizing stuff, right? That's by definition what they provide. But sometimes you may not have IQVIA Midas. You may only have local IQVIA and you want to stitch that together across countries, and that's when you need that, right? Or you want to compare that to your internal data sets. You do need some translation tables that are maintained, right? So think of step 2 as an automated data pipeline / deduplication / standardization, right? Number 3, automated machine learning engine, right? This is where you actually do the ad stock transformation on your advertising spend and your detailing activities. This is where you actually do the causal price elasticity modeling, right? This is where you do the right to price scoring based on the attributes that you guys have defined as a group and the weighting methods, et cetera, et cetera. But it's all happening within a proper pipeline. For your companies, that may mean it happens within some sort of a Fabric environment or Azure. If you're a Microsoft shop, which typically most companies are, or it happens in some other cloud-based data warehouse and machine learning environment. And then you have the outputs, right? And the outputs, again, could be CSV, it could be whatever else. It could just be a database that some tool ingests. And again, for many companies, especially if you're under, let's say, $1 billion, Excel is perfectly fine as the front end, right? As long as the underneath the hood, 1, 2, 3, right? Integration, automation for pipeline and machine learning happens in the background automatically. But you can also use Power BI, Tableau, or ideally you use some kind of an internal web app, right? And so the version that we're going to go through in the subsequent slide is an internal web app that we built based on all these concepts with all the data integration and the machine learning engineering underneath the hood. Again, anonymized data. Let's go through those.
Yeah, thanks, Armin. So this is the guided tour. Of course, this is all anonymized, but this is an example of what it could look like within a client organization. And these are actually some sanitized screenshots of that output. So at a glance here, you see the executive summary. We'll take you through the different views that we created for the different capabilities for this customer. And what you see here is basically what are the opportunities that are ranked, that have been identified for that specific customer. And so you have what the model thinks you can realistically capture. And of course, that's already incorporating the elasticity and the assumptions around the levers, around price or promotion and spending, advertising, and so on. You have the net expected benefit and the confidence level attached. And the beauty of this is that every recommendation shown here, you can see in aggregate, but you can virtually double click on any of these and be able to trace back to the actual data that drove that recommendation, right? So you're never asked to trust a black box, but you can click any of these and see which lever it came from and why the recommendation came together. Then the next part is the PM, the product equivalence matrix, right? So every one of these SKUs were matched. It's like for like to a competitor, molecule strength, and so on. And you could see how solid each of the matches are. The weak matches don't get hidden, right? You don't want to lose sight of those, but they are flagged and routed for a separate review so that you can actually have a cross-referencing that keeps improving over time instead of just ignoring what doesn't perfectly gets fixed. But you do need to have that confidence shown here so that people know that they can trust the matches, and that's building the recommendations, and therefore everything is tied together, as Armin mentioned earlier. The next one is the price per DDD, right? We mentioned before, this is one of the key building blocks to be able to come up with an equivalized price between you and the competitors. And this is then moving away from, hey, is this cheaper per pack or is it pricier per the day, right? Just like the example that Armin opened up the webinar with, is about having one consistent comparison that you can actually defend when you're in that room discussing what is the best outcome for the business, right? And so you can now start having conversations about where does the brand sit against the anchor set of competitors that you picked, right? And have apples to apples conversations about how different or similar the price is and what type of gap do you want to keep against competitors. Armin, I see there are some comments or questions coming in. If you want to take a look at that, and feel free to jump in or type away. The next one is right to price. And so this actually ties the two things together. It's one of my favorite ones here. So on one axis, you have the brand power, which is what Armin was mentioning before. So how much authority the brand has actually earned over time. But then on the other hand, you have the price per DDD. So what you're charging today. So you put in together, and now you have defensible bands. So the ranges of the brand strength and how much can they physically hold before you start outpricing yourselves to the market. And so when you start plotting these against your realized price, you can see that if you are below the band, then you may have an underpriced opportunity. So you have earned room to price more. But if you're above it, then you may be exposed, right? And this could be either because your brand equity has been losing some traction, or a new competitor come in, or Alicia was mentioning in the chat earlier, competition, right? A new competitor coming in with a new product can change the size of the brands and therefore where you sit in this matrix. Armin, did you want to chime in with anything from the chat, or it's?
No, I think someone asked a really good question, like what is the common volume lag for modeling elasticity? So we use IQVIA data, so no volume lag per se, but we recommend modeling done to be at the monthly grain, right? So monthly data, at least 60 months, which I know for some companies it's hard to collect, but 60 months of data, so ideally 5 years, along with historical A&P spend, et cetera. A&P is okay to have it at the brand level, but then also inflation, competitive prices, distribution. So that's how we typically build the model. And again, it's based on the syndicated data versus necessarily internal company level shipment data. And I would say one of the other things that I would just say is it's important when we build the elasticity models to also employ some hierarchical elements to it. So once we build the model initially at the SKU level, there's going to be many SKUs where the data is either sparse, or not enough history, et cetera, et cetera. So that's where you need to use some brand level hierarchical imputation or some Bayesian hierarchical modeling that we apply as a second step, just to get the coefficients also for SKUs that are more recent SKUs where we don't have the 5-year history. Great question.
Yeah, great question. Thank you. The next one is the price pack architecture. We have about 5 minutes, but I think we're in good shape to be able to finish the content today. So the price pack architecture, as we mentioned before, is the within family ladder, right? So how you're pricing within your product packs. And also there, you'll see examples here on the screen where there's opportunities where the lineage has broken and you have a chance to change the trajectory. Again, very visual, very impactful to be able to take decisions and explain the rationale. Armin, I'll pass it on to you for the next couple.
Yeah, so I'll move on fast, guys. Again, the next module that we have is price and inflation. So we have this a little bit out of order, but that's one of the first things that we look at is, has your pricing over time caught up with inflation, right? We not only look at your products, but also the relevant competitor set that you've set up. And so based on that in itself, you can figure out if there's an upside in your portfolio by catching up with inflation, which sometimes can be missed. And we typically pull those from each country's central government website. And again, that needs to be aggregated, put into the database. If you go to the scenario simulator, Enrico, so again, this is where it's hard to see on the slides, but you'll have the deck as well as the white paper. You can see the actual screenshots of the modules. This is where you can essentially model out different price changes along with advertising and promotional changes, right? So you can figure out what is the impact on your business, both demand level and financial/profitability. And you can also model out the impacts of competitor price moves, right? So there's a third section where you can model out what is the adverse impact if competitors also decide to follow suit. And the last piece is a white space. Again, we typically look at a couple of things, but we mainly look at the same kind of form and figure out if there's any pack sizes that are not covered by the market at all, or if there's any pack sizes in the same form that we are not playing in. And we estimate the upside of capturing some share of that market based on historical share grabs of new entrants in that particular market. So that's part of the underlying analysis that feeds the module. We also look at things like market stability and market fluidity. So market fluidity is a comprehensive score that does look at stability and market growth, et cetera, and also looks at how many new entrants and how many products exit the given market each year. Therefore, like what is the ratio of entrants and exiters in the market? And we capture a score. That score basically lets you know how easy it is for you to enter the market, right? If it's a score of 100 and you have a certain pack size that's popular that you're not playing in, guess what? That's an easy way to launch a new product and grab some market share, versus if the score for market fluidity is like 1 or 2, you know that it's really hard because it's dominated by some maybe a bunch of players that have grown over time, and it's going to be hard for you to capture the market. So I'll turn it over to Enrico to close us off.
Yeah, let's close it off. That's perfect, Armin. Thank you. So the real story, the real outcome for the client that we're showing you these slides, the good news is that we found 5% of price lift opportunity immediately and up to 20% with additional actions that the customer could be taking over the sequential quarters after that. What we found is in 4 broad areas: inflation recovery, as Armin mentioned, pockets of the organization that didn't quite keep up with inflation. Latin America, for example, was just skyrocketing some time ago. Those opportunities. We found some other opportunities where some price control markets, the countries were not pushing the envelope as much as they could have, and where the brand equity was allowing them to. But then the other one I would like to point out is the gray area on the screen on the right, and the last bullet point on the slide is the no action, right? So don't discredit also the fact that as we do this analysis, going back to the executive team and say, hey, these are the pockets where you think you're doing right? We don't see opportunity. That really builds a lot of trust and camaraderie with the team, because no one wants to have a consultant come in and say everything is bad, right? So it cannot be salvaged. That's rarely the case. And so there's several pockets where we've said, hey, this looks like perfectly priced. Don't touch it. It seems to be working fine. That also is an important takeaway. So wrapping up, how long does it take? Our experience is to do it right and to implement it. It takes around 3.5 to 5 months to implement it side by side with a client organization. This is, again, to do it properly, to have all the data feeds, to make it reproducible, and to make it sustainable, which to us is the most important thing, right? We don't want customers to call back all the time saying, we cannot run the process again. We want them to be empowered with this new layer of capability. So closing off, let me skip this slide. Closing off, you'll have the down paper, but if you want to download it, you can scan this QR code. If you have any questions or would like to follow up with us, book a call with Armin or I. You can find here, that's Armin's email. You can find us on Revology. Look for us in LinkedIn and connect with us. And yeah, you'll have all the information in the white paper. Thank you for joining us today. Any other closing remarks, Armin?
Great. No, thank you for closing us off. And thank you for those of you that have attended. I know we had a couple of different continents this morning, this afternoon. And so appreciate all the questions. Engage with us. You will receive the presentation and the white paper, which is more of an ebook, to be honest. It's quite extensive. You will receive those no later than Monday. Enjoy the rest of your day, guys, and have a great weekend. Thank you again for attending.
Thanks, everyone. Take care. Bye-bye. Bye.